So let us start our session while participants are still moving in. This is Jan Krahnen speaking. I want to welcome you for a webinar organized by SAFE together with CEPR and its new established research policy network on the European financial architecture. We want to welcome 4 persons who will speak today, a team from the European Central Bank and the European Systemic Risk Board. I will present them in a minute, who will talk about their latest report on the macroprudential challenge of climate change. So climate change has been a topic that's with us for some time, but it increases its presence. I would say even in this RPN, we just had a recent workshop that dealt with this topic. And I think the big challenge in this question lies in establishing the connection between what we see as the outcome of climate change, droughts, floods, melting glaciers, maybe impacts on food production and distribution in the world, and maybe many other aspects that are on the real side of the world. How do they impact other parts of the ecosystem, of the societal system, of the political system, of the financial system? And eventually, do they have anything in terms of impact to say on financial stability, which is basically the main aspect of today's investigation? And these links are far from obvious. And I'm also trying to think about this in my research and in our work here at SAFE. And so we are really interested to hear how the ECB is going about to dealing with this issue of complexity, actually. And it's not only a complexity at a certain moment in time where this complexity exists, of course, but it's even more so a complexity that spans long periods, and you have to estimate an impact that may happen in some point in the future, while in the meantime, many of our actors can adjust. They have expectations, they may take certain actions, and to take all this in a bigger picture, in a modeling environment, that is something which I think is a courageous endeavor, and I'm very happy to have Paul Hiebert and his team here to talk about this. So we will have a presentation of about 45 minutes following my short introduction, and then there is time for discussion. We have the Q&A section in your Zoom screen, which you please use to put up questions, which I will then read out and use alongside with my own questions that may emerge in this debate. So let me just quickly introduce the team. It's led by Paul Hiebert, the head of the Systemic Risk and Financial Institutions Division at the ECB. His work and the work of the whole group enters into the financial stability review that the ECB is publishing every year. Paul has an experience of 20 years at the ECB in many roles, not only ECB, IMF, Reserve Bank of Australia, and the Canadian Department of Finance were different places where he had been working. He holds an MA in economics from McGill. So I guess you are Canadian?
Half Canadian.
Yeah, half Canadian. Okay, good. So he will lead the discussion with an introduction and an overview. And then we have one statement that will focus on measurement, one on modeling, and one on macroprudential policy. The first one on measurement will be presented by Stephan Fahr, who is co-author of that study. He's in the team, he leads the team on structural banking issues. And he has been working a lot on interconnectedness, as I understand, and also on a monitoring framework for climate-related risk, which is basically what we are talking about today. He has a PhD from the European University Institute in Florence. Then there's Katarzyna Budnik, who comes from outside, at least so for those on the screen, it will all look alike, but she has a separate window. Katarzyna is an advisor in the stress test modeling division and working in the European Central Bank since 2010. She was heading the forecasting division at the National Bank of Poland and has a PhD from the Warsaw School of Economics. So welcome, Katarzyna. And then there's Michael Gill, who will talk about macroprudential policy. He is the team leader in the Financial Regulation and Policy Division at the ECB, 10 years of experience in this institution, but also working with the Basel Committee on Banking Supervision, Financial Stability Board, and the European Systemic Risk Board. He's holding a PhD in economics from University of Mannheim and a diploma in mathematical finance, which is probably helpful for your study from the Technical University of Munich. So welcome all of you. We are all excited to hear your presentation. I hand over to Paul.
Thank you, Professor Krahnen, and for the introductory remarks, the kind ones. I think it's to say at the outset, this is a project team which involves the European Systemic Risk Board and the European Central Bank working in tandem. And for those of you unfamiliar, the European Systemic Risk Board is quite a broad body, and I'll come around in the next slide to show you what that looks like. But basically, it's very much a collective effort in that respect. We're established in 2019. Now, I think it's useful to recall the purpose of what we're doing. And that was to try and leverage the quantitative expertise across our membership in a very much a system-wide perspective. So financial system-wide, not just thinking of climate as an issue which is compartmentalized in banks and insurance companies or in investment funds, but it's something which affects all of it, probably simultaneously. So with that in mind, a lot of initiatives have sprouted up throughout the years since 2019. We've been publishing our reports annually. The latest one, indeed, is in July this summer. And the idea is work just continues. We're very keen to get your inputs. What I can say is the following. We noticed thus far, so leading up to the July report this year, that climate change is something which tends, as Professor Krahnen already pointed out, to be one with aggregate impacts, which are perhaps not so overwhelming when you notice that they're distributed over many decades. And I think the question we wanted to ask is, could there be systemic amplifiers, which may mean that this sort of reading of a smooth transition of potential concentrated risks staying in pockets is maybe the wrong way to think about this, but that these risk concentrations could propagate in the cross-section, or you could have the buildup of risk, which is bumpier than, say, it's a smooth transition. And hence, with these types of notions in mind, that gives rise to the idea that, well, there could be a macroprudential dimension here. There's a time series dimension and a cross-sectional dimension we need to think about. And with that in mind, that's the work you'll see today speaks to this. So how can we think about this as a financial risk? Of course, there could be other systemic amplifiers which are not financial. So some of the social, political things were mentioned in the introduction. We don't touch upon these for now, but of course, this is a challenge and will be along the way. But for now, we look at least the financial, the narrower financial dimension, and talk about some of these systemic amplifiers that give rise to a 30,000-foot, I'd say, a view on macroprudential policy options. And arguably, we're one of the first reports to look at that for the Euro area and the European Union. So just to advance the slides, we have, I think, if I advance one more slide here to the next one, it shows basically the way we're organized. And that gives you the idea. It is very much a collective undertaking. As Professor Krahnen said at the outset, we do have then three streams that we're going to present today. You are, I think, fortunate enough to have the actual workstream leads here to present these to you. And it was a collective undertaking that involved all of the membership, really very broad, of the European Systemic Risk Board. And importantly, what that means is we have sitting at the same table, the banking regulators, the insurance and pension fund regulators, and also the financial market regulators. Hence, we can have that system-wide view. Now, with that in mind, as we're just advancing the slides, we'll just take a minute to do that. What I would suggest is we move over to the measurement part to start with, which will be Stephan. Kato will present modeling questions, and Michel will present policy options before we come back to conclusions. Do please prepare your questions. We're anxious to hear them. Stephan.
Thank you, Paul. Indeed. So first of all, the measurement part of it, and this is very much speaking to the cross-sectional dimension that Paul mentioned so far. And we had kind of a strong investment into kind of using granular data and to actually getting at the data. So what we have then done is to categorize our measurement into these 6 boxes. The first part is on exposure dimension, that's the left green column, and the right column is then moving from the exposure to the risk dimension. This is an important shift in order to indeed come to the financial risk dimension of things. And we have kind of ordered it from an institution-specific, non-financial and financial dimension up to the system-wide part, which is what Paul also mentioned, which is the novelty, so to say, which we bring in this report to the analysis. And what you can see is really that we start from top left, climate-related risk from non-financial sector, to then in the middle row on the right to the vulnerabilities of the financial sector. And all this is very much institution specific and using very granular level data of individual firms, individual banks, individual companies, financial companies. The lower part, the system-wide part, is then the novelty, as I said, and we identified 3 layers on the exposure side, starting from climate itself. There may be interdependent physical hazards that, for example, relating heat stress to wildfires, but also in the real economy. In and output interdependencies generate certain transmission of shocks in the real economy. And finally, the financial institutions, through overlapping exposures, may then have amplification mechanisms that lead to, on the right-hand side, the clustered risks or joint defaults and files. So this is the overall structure, and now we'll go a bit more in detail through individual slides, starting with the physical risk exposure. So what we used here is data for 1.5 million individual firms, and we associated these individual firm locations to the physical hazards that exist. And a range of, so the data that we're using is already compiling a range of physical hazards, and the work was to associating them to the individual firms and having a geolocation at address level of these firms and their exposure. So this is what you see on the left-hand side for Europe. And we have categorized the exposures to kind of high physical risk or no significant exposure. And one can clearly see that risks are present on coastal areas, but also in some Central European areas and around the Mediterranean basin. So this is at the firm non-financial companies level. In the middle chart, we then ask, how are banks exposed to this? By lending to exactly these same firms. So we matched the firms to the individual banks and to their credit exposure. And what we can see there is the major exposures are towards water stress and heat stress. And if we ask the question, what is the exposure to any hazard, beyond an increasing exposure, so the orange part, we can see that a bank's credit exposure is roughly 30% towards these relatively elevated levels. Now, one would say taking these risks at face value, but there is a possibility to also insure against some of those risks. And what we found together with our colleagues at EIOPA, at the insurance supervisor, is that the insurance gap, the protection gap, is quite heterogeneous, both across hazards, and this we see on the right, as well as across jurisdictions, which is the horizontal axis. So those that are kind of red or in reddish or in amber have low or medium or even higher, larger gaps, and may pose risks going forward because of the question, who would take care of these losses that would be incurred? And one might be the sovereign. Now, looking a bit more at the systemic part of physical risk, I already mentioned there are possible interdependencies of natural hazards. We looked through the literature and we found relatively little literature on this, but what we found, we compiled it here, and where we can clearly see, for example, a strong link between heat stress and wildfires, but also a self-reinforcing loop that may exist for heat stress and wildfire. So once we have heat stress, it may reinforce over time. these risks. And the similar thing for others like rain that obviously are associated to hurricanes and windstorms, but also to floods, which is an important link. Now, this is on the hazard level, this interdependency, and on the right-hand side, we have overlapping portfolios of different financial or non-financial sectors. So how are these assets of these sectors kind of exposed to certain hazards, and are they overlapping? Are certain hazards generating very particular risks and clustered risk across sectors? And we find, for example, that the wildfires would have a stronger effect on financial sector, but also others have kind of cross-sectoral spillovers. So moving from physical to transition risk, this is more kind of a traditional work, so to say already. We looked at what is the exposure of banks, bank loans to high emitters, medium emitters and low emitters, divided by tertiles, so 33% each. We see that 2/3 of bank loans is still towards high emitters. Regarding securities holdings, we have banks, insurance companies, and pension funds, as well as investment funds. This is broadly kind of a 1/3, 1/3, 1/3, whereby investment funds have also to lower emitters there. Now, when looking at this at such an aggregate level, one is brushing aside some of the granularity of the data that we're working with. And this one can better see on the right-hand side. As an example, this shows emission intensities, meaning CO2 equivalents over revenue, and does so for different sectors, and shows the box plots for those. And taking one as an example, electricity, gas, and steam, we can see a huge variation in this emission intensity, and note that the scale is a logarithmic scale. So we're talking about a factor of more than 1 million across those extremes that are there. Hence, we need to think about how to address and incentivize specific firms, and this will be in the policy part an important element. Coming now to this evolution over time and moving from exposure metrics to the financial stability risk as we aim for. Here we show a vulnerability metric. So what we do is we multiply the exposures or the loan weighted exposures of banks with the probabilities of default. These probabilities of default are not necessarily linked to climate, but they already give an indication of the vulnerability. Hence, by multiplying the two, we get a feeling of, though vulnerable firms become even more vulnerable due to their climate-related exposures. And what we see here is that over time, this is the case for the electricity sector or the manufacturing sector. And just to gain an indication of the difference between exposures and this new metric, this vulnerability metric, also we abbreviated as TCI. On the right-hand side, we do a direct comparison. So in yellow, you have the loan carbon intensity, which is the bank exposures and weighted carbon intensity. And we have normalized it for the top emitting sector, the mining sector, to 1 for both metric. And then blue is transition to credit risk intensity, this TCI. And so the risks that come from or the vulnerabilities that are indicated by these TCI show that the risks are way more equally distributed across those sectors than when one looks only at the emissions themselves. So the blue bars are more similar across sectors than the yellow bars. Coming to the systemic part again, and on the transition risk. Here, what we did is we took individual companies, non-financial companies, and we computed the pairwise default correlations across them using Moody's data. And what we can see, which is the far left, the zero is in red triangle, that correlation is 0.5%, so relatively low, but it's important to see that. And this is important also for diversification within the financial system. Now, if we now move a carbon tax or any other carbon price up from 0 to 200 in this example, this correlation increases and the red triangle moves from 0.5 to 0.9. On the extremes, the 95th percentile, this is 2.5, moving from 2.4 to nearly 3.5%. Hence, this common shock from the transition risk may be an important element that will make diversification within the financial system more difficult. And this will be one of the parts where we want to look more in detail into it and also into the regulatory ramifications of it. An additional aspect on transition risk and systemic amplifiers is the real economy interdependencies. And the question that we asked here is, if we want to reduce emissions by 10 or 20 or 30%, how would demand need to adjust in order for this to happen? So this is on the left side. So for 10%, it's in blue, and we consider direct and second round effects, and the most affected sector is the air transport sector. Now, with this reduction in demand and output, we also have implications for the financial system, and here for the banks. So what we then, we fed the lower output into a PD model, into a probability of default model, and then calculated the losses that the banks would have. Now, we didn't want to be exact on the PD increase, so you may choose a number, 100% increase or 200% increase for a unit of output loss. But what you can clearly see is the stronger the reduction that one aims at, from moving from 10 to 30%, and the stronger the probability of default that we would kind of assume, the more the banking system would be drawn in, and we will also look at that in more detail. Now, this is it for the measurement part. I pass it to Katarzyna for the modeling part on the next, starting here.
Okay, while Katarzyna is unmuting, perhaps I can say a few words. So whereas Stephan has already presented to you the idea of risk in the cross-section, and if you will, the risk distribution, Katarzyna would be turning now to talk about risk evolution. So how this would evolve with time, thinking that climate is probably something where the past is not a particularly good example of what is to come. So we really are faced with a structural break. So with the structural break in mind, it's important to think about scenario analysis. And Jan Peter already talked about the importance of this for climate work and bringing this forward. So I'll keep speaking until we solve the technical issue, I think is best, just to ensure that we keep the momentum. Katarzyna, you can correct whatever I say afterwards if I say something that's not correct. So let's say the following. I think there's 4 building blocks of scenario analysis. And the 4 blocks are ones which Katarzyna will go through. And we analyze in this report. So the first is really about scenarios. And I think one of the benefits of having a system-wide perspective is we're able to actually implement scenarios in a consistent way to try and look, at least prima facie, at how the different institutional sectors, banks, insurance companies, and investment funds might react if they're hit with a common set of shocks. So with this in mind, you'll see in this there will be the network for greening the financial system scenarios, which have become largely the industry benchmark. But I think importantly, what Katarzyna will show and her team has done is to also look a bit more at short-term scenarios, which are quite decision relevant in a sense, because that's obviously, you think about politicians through the financial sector, through any other sort of actor in the financial system, often, our discount rates start to increase after you've reached the decade-long points. The second thing in building block here is really about modeling and uncertainty. So that's the idea of stress test parameters are important to model in a way that is robust And we are faced, of course, with the need to construct models which are suitable for climate-related questions, not just the traditional macro-financial questions we face. So we looked through our membership, and looking through our membership, what we saw is that obviously there are a variety of things.
So her microphone is not working.
Katarzyna, I'll finish this slide. There you are. We hear you now. You can now
Yes.
take over. So I've given the first two blocks, the second two.
Thank you very much for rescuing the situation. So let me kind of come back a bit to what Stephan was saying. And just as Paul was introducing us to the modeling part, I tend to introduce this topic a bit from the angle of that we started where Stephan and his group ended. So the moment we leave the work stream of Stephan, we already know what are the exposures to different climate-related risks. You already know and have a sense of a certain measure of vulnerabilities. So what are the probability of different events? But what we are still missing is the detailed description of the transmission of those risks. So detailed transcription of what would happen had those risks realized in some plausible scenarios. And that brings us into the stress testing. Stress testing as such consists of 4 parts, and all 4 parts were covered by the workstream. So we can think of stress testing as relying on certain scenarios. We can think of stress testing as a place where we developed models which serve mapping of different scenarios into the exposures of the financial system, conditional on the scenario. We can think of modeling and stress testing as something that describes the broad-based transmission of such scenarios. And last but not least, we will come back to the topic of amplification, but putting more emphasis this time on the amplification within the financial system. So if we move to the first part, scenario be it, we did 2 things in this vintage of the project team. First thing is that we came back to analyzing so-called long-term scenarios. So the way climate is considered in scenarios, it's usually perceived as something which will take some time to realize in full. We look at the scenarios of 50 years, 100 years ahead, and we are very much inspired by NGFS family of scenarios. And here you see just an illustration of 3 NGFS scenarios we focused on. On the left-hand side, maybe there's a quick characterization of all 3 scenarios. So the blue line will be our baseline, and this is, we are doing nothing. Current policies, meaning that the emissions of carbon will continue and they are unlikely to be reduced going in the future. And then we have 2 alternative scenarios. One which I would call a good scenario, so it's a net zero emissions, where we act very decisively and from the onset, reducing the emissions sharply, and the delayed transition, which is the yellow line. So we do act, but 10 years later, and possibly inducing additional costs on the economy. And on the right-hand side, we have an illustration of these costs for the economy. So we have blue bars, which is how much we gain in terms of GDP output if we act early and responsibly. And you see that we have a gain in terms of EU GDP of 2 percentage points in the 10 years horizon, accumulatively 3 percentage points in the 30 years horizon. Then we have also similar assessment of what would be the costs or costs and benefits from the delayed transition. And again, blue fields, which corresponds to the EU setup, tell us in this case that the delayed transition will induce no changes to the output compared to the current policies in the short run. In the longer run, it will first introduce costs and then gains. So there's another way of looking at this chart is that delayed transition is still beneficial compared to not doing anything. But by delaying action, we also experience quite some losses compared to the first best scenario, which is net zero. This was the first thing we've done in terms of scenario. The other thing we've done is in the next slide. And here is the question we ask ourselves. Okay, our experience so far was showing that if we take those long-term scenarios, we put them to the models and the whole story as I started, we end up on the impact on the financial system, we did not see much of an impact often the times. And after a few tries, we understood that it might be because those scenarios are very long term and the adversity is thinly distributed over longer horizons, which means that the adversity is there, but we might sometimes miss its existence, giving a falsely reassuring signal that climate risks don't matter. To overcome it, to try something new, we considered an alternative near-term scenarios. So it would be a family of scenarios which unfold risks within 5-year horizon and emphasize one risk at a time. And we picked up 3 of them, one in which carbon prices sharply increase in the short run, one in which we have strong intensification of floods, again in this 5-year horizon, at the beginning of the 5-year horizon, and then the third one, which is the heat waves. So this was our experimenting area in which we will try to explore, are there any alternatives to long-term scenarios which can illustrate different aspects of climate adversity? If we move to the next slide, there is already change of topic. So if you recall, first thing we do with scenarios, the second thing we wonder how those scenarios are reflected in variables, parameters, which affect directly financial system. And a few examples. The report includes much more examples of those, but here we focused on corporate probabilities of defaults and on costs of equity and bonds. How to read those charts? So we take the scenarios, in this part examples, these are those long-term scenarios, and we consider how probability of default of the corporate sector in the EU would evolve over the horizon. And again, we express it in comparison to the current policies. So if we look at the blue line for a start, it will show us that probability of default in the short, like when we have a timely, orderly, and generally positive transition, will increase subtly in the short run, which is a bad signal, but it will be reduced sustainably and substantially in the long run. So this is this positive signal. If we have a delayed transition, it's like we delay the costs and we experience a bit lower benefits in the short term. What we see in the corporate sector, but this time equity prices and bond prices is pretty much the same storyline. So if we act early, we see that the valuation of equities and valuation of corporate bonds generally benefits in the medium-term horizon, whereas the picture is a bit more blurred if we delay the transition. That brings me to the third part of what we have been doing, is that let's take those parameters and let's put them to our models to get a comprehensive picture of how the climate risks would affect financial institutions. And we did this exercise for 3 sectors: banking sector, insurance sector, and investment fund sectors. We did it for all scenarios we had at disposal, whereas I will focus mostly on the long-term scenarios. This table includes plenty of details about the assumptions underlying the simulations and as well as the sample. But let me show you the results in the next slide and see what we were able to identify for the first time. First time, because it was the first time we ran this type of exercise for 3 sectors in, to this degree, comparative fashion. And you see the impact in net zero scenario, a good scenario, compared to current policy scenarios on the left-hand side, and a disorderly transition compared to the current policy on the right-hand side. So first striking feature on the left-hand side is that red bars are generally higher, and they are like that. They also have this path of sharply higher in the short run than in the long run. compared to the blue and yellow parts. What does it tell us is that the first sector which will be affected by realization of climate risks is likely to be the sector which has the most market risks on their books, which are investment funds. The other sector which can be affected in a very short run, and these are the smaller yellow bars, is an insurance sector, for exactly the same reasons. In comparative terms, banking sector will react the slowest, and this reflects more of a banking book features of the banking sector when we have amortized costs, where the losses feed through slowly through loan loss provisioning rather than the market risk immediate impact. And this is what we found very interesting in this exercise, is that we were able to see not only the magnitudes, but also the different paths. Sectors which react faster and sectors which react slower. And we did exactly the same exercise, this time without numbers, but with qualitative assessment on which sectors will react faster or slower in terms of adjusting their balance sheets. This dynamic balance sheet dynamic. Interestingly, we found more or less the same features. So the fastest reacting sector will be investment funds. The slowest reacting sector in this case will be insurers. The slowest will be insurers, exactly, and the banks will be in the middle. So with those two things, we managed to compare systematically how the risks will propagate through the system, consisting of different actors. And being in the different actors, the last slide with this part was putting again the same scenarios in the model where we jointly model the behavior of three sectors. So we have banks, we have insurers, we have investment funds. They are interconnected directly and indirectly, so they have common exposures. We introduce the shock, we introduce credit shock and market risk shock to this model, to each of the three types of institutions. And in this chart on the left-hand side, you will see this initial impact as marked as exogenous. So it's a blue impact in terms of market risk and red impact in terms of default risk or credit risk. And then we let it run. We let the agent in the model adjust, sell assets, default, you name it. And we get this endogenous amplification mechanism, which is marked here in yellow for the market risk and green for default risk. And again, an interesting outcome is that most of the amplification, again, comes from market risk, from market prices. And this amplification is significant. So if you compare blue bars or even blue plus red bars with the outcome which comes out at the end of this feedback mechanism, they are significantly amplified up to 4 times. Similar picture with different emphasis on with different degree of amplification and different emphasis on relative roles of risks on the right-hand side. And Michiel, the floor is yours.
Thank you, Kata, and hello also from my side. So before diving into the details of the policy chapter, let me first recall the main or key analytical findings of the work of this task force that is around this project team. This is around already for 3 years. So on the cross-sectional dimension of systemic risk, we have heard about the concentrated financial exposures at different levels and the potential systemic amplification that could exacerbate such concentrations. When it comes to the time series dimension of systemic risk, Kata very much emphasized the path dependence. So the losses that may occur very much depend on the path we will be on in the future. And we have also seen that losses, where they occur, depend on these paths, and they will be also sequenced. So first we may have losses due to market risk, but these might be followed by credit risk. So why are these analytical findings important for policy work? There are 2 reasons for that. So first, building on the evidence on systemic risk, and we can make a case for macroprudential policy to address climate risk, complementing macroprudential and public policies. And second, when it comes to the selection and calibration of policy tools, we need to very much base our decisions and inform them based on the evidence unearthed by the team. So, for example, the work on concentrations very much guides our thinking on potential concentration risk measures. And when it comes to time system management, we also need to think about how we might phase in or how we might calibrate tools depending on how the situation, how climate risk evolves going forward. Now, turning to the next slide. So, as I already mentioned before, the project team is around for some time. So for this edition of the report, it was the first time that policy considerations were a part of the considerations. And for that reason, we started out with building a case for macroprudential policy. So we first attempted to make clear why macroprudential policy is needed, complementing other policies. And we particularly emphasize that with its system-wide perspective, macroprudential approach can help to address risks that cut across sectors. So we're not only looking at individual sectors in isolation, so we really, with macroprudential policy, is able to have this holistic perspective. And it may also then, in a similar way, and also help to limit arbitrage that may occur across sectors. So next to the building the case for macroprudential policy, we have also dedicated quite some time to discuss the potential interplay of macroprudential policies with other policies. And here in particular, microprudential policy is an important aspect, and how microprudential policymakers should interact and could pull together. Finally, we have also considered how macroprudential policies will depend and also interact with the set of public policies, which, as we highlight in the report, is the first and foremost responsible for limiting and adapting to climate change. Whereas macroprudential policy should remain risk-based, so should deal and target the risks that emerge from climate change. And last but not least, in this report, we have also highlighted a few potential tools that we should explore further or could be employed to address the various systemic aspects of climate risk. So for the banking sector, we have considered concentration risk measures using existing buffers, whereas for non-bank sector as well as financial markets, we also have looked at the insurance protection gap and the need to strengthen market standards. And then we'll go into more details in a bit. Turning to the policy interplay and the coordination of policy makers. So macroprudential policy cannot act in isolation. This is very important. So it has to be seen in the context of a holistic prudential approach to climate compliance. And actually, some of the measures we discussed also in the report may well form part of both a micro and a macroprudential approach. So we could be motivated both from a macro perspective, could be based on both types of considerations. And in this Venn diagram here to the right, you see particularly the tools in the middle, like common minimum requirements for banks, climate stressing, bottom-up, top-down, transition plans, disclosure requirements, which very much could be part of both type of policy approaches. So there needs to be close coordination between the different authorities. Then one authority is acting, it needs to take into account what other authorities are doing. So there needs to be a holistic common approach to policy making in this area. Obviously, there are some requirements that would more likely fall broadly into the macroprudential approach, whereas others fall more into microprudential approach. But nevertheless, I mean, we need to be aware of the impact this has, what kind of risk we target, and also to avoid overlap and not possible double counting of risk. Finally, there's also it's also important to have global coordination. So in the Basel Committee, in FSB, so we need to make sure that there's a consistent global approach to addressing climate risk, also given the global nature of climate change. Now turning to potential tools that could be employed for the banking sector. So as I already mentioned, these are what we have in the report, our initial consideration, our initial assessment, and going forward, we will very much build on these initial observations and deepen our analysis to come up with more in-depth analysis, how such tools could be employed, how they could be calibrated, and under what circumstances they should be employed. So in terms of policy options where we see that there's a strong rationale to use them for climate purposes, we've identified 3 tools. So starting with the systemic risk buffer, which is a buffer that is already in place in European legislation, which is there to address systemic risk, which are not covered by other buffers like the countercyclical capital buffer or the TCOC buffer. And in principle, it can be already used for addressing systemic aspects of climate risk. There's a need potentially to clarify certain aspects. There's obviously a need to develop a methodology to calibrate and to calibrate it. But in principle, it's there. And going forward, we will also continue to look into this and come up with ideas how to use it in practice. To note that there's also a sectoral application of this buffer possible. And here we also need to critically think about how this could be possibly in the future be applied to certain subsectors, keeping in mind the heterogeneity within sectors that Stephan highlighted early on when it, for example, comes to the emission intensity. Turning now to the concentration risk measures. Here we have, we see concentration thresholds as a potential candidate that would select banks that have exposures beyond a certain threshold to high emitting sectors or to areas prone to physical risk. And these banks would then face either further supervised scrutiny, so there could be possible follow-up by supervisors, or possibly also other measures. So the idea is here to have some framework to detect banks at most at risk, most vulnerable to concentration risk, as highlighted by Stephan, and to then follow up with more specific policy action. And again, here we aim to continue the work and think about how this could be used in practice, how this could be possible. Finally, we also think that potentially borrower-based measures could be a useful element in the macroprudential policy response to climate risk. Here we are particularly thinking about using existing tools and sort of bringing in some climate component to address specific aspects of mortgages, whether they're energy efficient or prone to physical risk, and possibly also new tools that could complement the existing tools. One word on the other tools that we have considered. There are a number of tools that have been given a neutral or less suitable attribute. So we don't think necessarily at this stage that they could be very usefully employed for climate risk purposes, but we will continue our work there, also continue to consider them going forward, and possibly we will, there's also a possibility to change our assessment there. Last slide from my side. We also have discussed potential policy measures from a macroprudential perspective for the non-bank sector, as well as potential additional disclosure measures. So let me just briefly highlight that for investment funds and financial markets, we particularly see a need for harmonized standards to address greenwashing risk, for example, in ESG funds, or we also have given some consideration to potentially use a mandatory standard for green bonds in case we see a proliferation of different standards in Europe that might give rise to potential amplification effects in case greenwashing risk materialize. For insurance sector, large focus was on the insurance protection gap. And here, in terms of when it comes to addressing limiting this insurance protection gap, we have highlighted there might be a need for private elements, so risk, so private solutions in the form of targeting insurance products to climate to provide incentives for insurance holders. There might be also need for public-private risk-sharing solutions, in particular if private options are insufficient. And there might be also a case for European risk pooling, given the cross-border nature of climate change. Finally, there's also a need to enhance disclosure requirements. In particular, we highlighted key standardized forward-looking metrics might help to improve the quality of forward-looking disclosure, and here also public sector guidance might be essential. And this is from my side, and I give the floor to Paul.
So there's quite a rich report, and you've heard us try to go through it and unpack it for you today. I won't go through this summary slide in detail, just to say, of course, Stephan talked about measurements. This idea of concentrations of risk could maybe be amplified. Coming back to what I said at the beginning, it might not be that these concentrations remain contained, but much like you saw in the subprime crisis, they can amplify in a cross-section and propagation. Katarzyna talked to you a bit about modeling and how this risk might unfold and how that might be a bumpy transition, what elements could be there. And of course, Michael then described to you some elements of what high-level macroprudential reflections would we take away from these this accumulating body of empirical evidence that we have thus far, and to work forward. Now, just to say, this work of this group continues. So I'm very anxious to hear your questions and have a rich discussion so that we can also ensure that our work is robust. So back to you, Professor Krahnen.
Yeah, so thank you. That was a long presentation. And I would now invite participants to think about the part that they may not have fully understood, or where they may have a question. So please put anything that comes to your mind in the Q&A section. Also, if the question is really, could you please explain again what I saw on slide 17, because the presentation was fairly fast. Slides were really complex, so I think it's not so easy to grasp them by just looking at them for a few seconds. And please don't be hesitant to ask this way. And I will start with a question, and basically let me ask almost a philosophical question. So what type of scenario analysis are you really trying to do? You are not forecasting, right? But you try to, as I understood, you're not predicting what will happen, but you are trying to say, if nothing is adjusted in the way we operate, then this might be an outcome. Is that correct? Is that the way is this a correct interpretation? So if you do some extrapolation to 2050, you basically take the current regulatory framework, the current balance sheets of bank, credit exposures, all that as given and stationary basically, and then just change, let's say, the outcome of particular variables on the cash flow side of loans. Is that a right way, the right representation?
So why don't I say a couple words and pass to Katarzyna for probably a more enlightened answer. So I think it's a good point that we are in rather uncharted waters when it comes to climate scenarios, which are so long term, where you need to mix environmental science considerations, so greenhouse gas emissions in the atmosphere, and what contribution you have, of course, of man-made or anthropogenic activity to this evolution, and link that somehow back to economic and financial variables, which matter for the models we tend to deal with, the class of models. So both the scenarios, I think, are challenging, and adapting our modeling apparatus, both to deal with long-term questions, with a very strong sort of emphasis on resolution, granularity, is on one hand. And I think the other element that you have to think about here is that we're not necessarily in the business of having climate adaptations to our models as yet. So Katarzyna shared some of these examples. So Katarzyna, I think I could pass to you to explain a little bit about how philosophically the scenarios work, which we largely draw from the network for greening the financial system, where we have this interaction with a consortium of environmental scientists.
Right. So let me be precise on, and if Katarzyna is answering. So my question is really, what do you vary in your scenarios? Is it just the natural part? So what's happened with floods and disasters and heat and all that may have some impact on some regions or some type of production? Or is it also the intermediate part that is the whole, let's say, financial system, economic system, regulatory system, that of course is not stale, right? It's not sitting there waiting an accident to happen. We all know these accidents are happening. So just to motivate my question, my starting idea was there is no risk for the financial system from climate change, right? Because we know it, that it's coming, so we prepare.
Katarzyna, I think this is probably a good place for you to step in about static versus dynamic balance sheets.
Now questions are coming.
So a very fair question. So let me kind of first maybe anchor this philosophical question, answer on what is forecasting. So if I were to forecast the reality 50 years ahead, not discussing how good such a forecast would be, I would try to take into account all plausible adjustments which will take place. Regulatory adjustments, adjustments in terms of carbon policy, etc. So in this sense, we don't do forecasting because we develop just scenarios, which are conditional on a set of sometimes even artificial assumptions. So what we vary as the first stage between our scenarios are carbon emissions. So the scenarios are implicitly have the same regulatory setup. Nothing changes in terms of laws, but we have different climate policies, different carbon intensity, and resultingly also different degrees of intensification of climate risk. So this is what all the scenarios have in common. And then what else we release or what else we keep fixed differs a bit from in each slide I was showing. So some of our exercises are based on so-called constant balance sheet perspective. And in this constant balance sheet perspective, we take those scenarios, varying in the degree of carbon emissions, and plug them to the financial system as it looks today, assuming that the financial system will not react. They are just passive victims of climate scenarios. Then however, the two last exercises we've done were the exercises in which we kept the regulatory setup the same, but we allowed the institutions to react. And of course, this is still fully equipped with lots of assumptions about how they will react. But at least conceptually, we allowed them to adjust their balance sheets as they face different risks on different parts of the portfolios. And these are the elements which we call either dynamic balance sheet or the elements which we put under the umbrella of amplification mechanisms. So the question was double fair. One fair thing is just to say that we don't do forecasting. We always condition on a certain set of what would happen if. And the other is that we do vary and we do experiment with different assumptions about what financial sector will do.
Okay, so yeah, thank you. So I have a long list of questions now, and I will probably go through them, but I just would like to understand a bit better this one part, and then I go to the further questions. So you were talking about climate risk and firm default risk, and you multiplied them and said we have a risk-weighted, as there was one chart that shows this, and you diagnosed increasing credit risk intensity in your scenarios, and I just don't understand the micro foundation of that. If there is an increasing perception of riskiness, and I'm assuming that this is what you are predicting, everybody can predict, right? So every lender can predict. So they might take insurance, they might ask for collateral, they might simply increase the price. So where's the risk?
Just to be clear, to differentiate between the time scenarios that Katarzyna was dealing with and the PDs that were shown there, and the vulnerability metric that I showed, where we multiplied the exposures and to climate risk of NFC of non-financial corporations, multiplied by the loans that banks grant to those banks, and then multiplied by one or existing vulnerability, which is the PD of those banks. So this we deliberately call it a vulnerability index because because this PD is not generated by the climate risk itself. It's generated by many other things. So and it is a crude way of getting a handle on that. What we have observed is that kind of, especially in the interaction with rating agencies, that they are also working intensively in incorporating climate-related factors into their risk modeling. This is ongoing, and the different rating agencies have different approaches, and these are kind of more sophisticated on some grounds, or multi-dimensional on certain sides. And it will appear probably in a future version that some of those climate factors will enter into the probabilities of default, and thereby, exactly as you say, have a knock-on effect on pricing, or on additional requirements for buffers because of that. So this is how we see, but generating kind of these metrics are nevertheless helpful to have a sense of where the economy and the banking sector are going.
Okay.
If I may just add one additional consideration, so I think you're a bit hinting also at the question of if you see risk weights being adapting to climate change, so the micro framework possibly sort of, and banks sort of in the risk management adapting to climate change, what is the role for macroprudential policy then on top of that, if I understood you correctly? And I guess one answer to that is, yes, the expectation is that there will be slowly, surely somehow we will see climate risk being incorporated in the prudential framework, in the microprudential framework. Supervisors already pay attention. We had climate stress tests already from supervisors. So this will take care, I would argue, in particular for idiosyncratic microprudential risks. So which we can probably measure at the individual sort of a loan level. This should be reflected in this risk. But climate risk has also systemic aspects. And this is possibly where macroprudential policy needs to come in. So broad disorderly transition scenario will hit a large number of firms at the same time. How do you factor this in the individual risk weight? Not sure if this is possible. How do you take into account these concentrations of portfolios in certain sectors, which may again then in certain scenarios be a tail risk that is not necessarily captured by microprudential rules. Mm-hmm. So I guess this is sort of where I think where there might be a role for macroprudential policy to sort of address those risks stemming from climate change that may not necessarily be captured by a micro framework, but rather need a systemic response.
Mm-hmm. Okay, so that is my general question may not be easy to answer because it's in a way hidden in the structure of your model that takes a shortcut by just saying, well, we take the climate risk that we model as a substitute for all the other changes that are happening in the system to adjust for exactly that climate risk. So for instance, I see a big risk factor for banks, not so much in droughts and floods and so forth, but in the fact that policymakers respond to expected droughts and floods with regulatory changes that somehow create worthless assets, so to speak, stranded assets, in a surprising sense. So is your idea you capture that implicitly by simply looking at climate factors rather than at the system itself?
I think maybe Kata is best placed to answer it, but I think the disorderly transition scenario, but also part of his scenario analysis, is aimed to capture such type of scenarios. Mm-hmm, but, so there's so Kata, are you?
So well, I think it's a very fair question, first of all, because let's say the short and bit dismissive answer would be to say that you are right, that in principle, we assume a certain degree of irrationality on the side of firms So we assume a degree, and in different exercises, I'm not saying only about PDs, but in different exercises, we assume that there are deviations from the perfect foresight, and there are deviations from the perfect coordination. So this is like one thing that, like, let's say, the intuition behind this would be like this, that we do assume that, for example, heat waves are not fully anticipated, and they are not fully linked by the corporate sector to what emissions are today. The other thing we do assume in each and every exercise in this report, and this is one of the silent assumptions, that the firms are passive. And that's why we have also this increase in PDs. So firms are affected, let's say, deeply by transition risk because they never ever adjust their production structure. So you can see our exercises as the illustration of an extreme case of passivity of the private sector and its limited rationality in reaction of climate risks. But that such limitations on the corporate sector or household sectors exist, I think we've seen many the times. So in this sense, we do think that implicitly that the policies that steer the system in the right direction are something which might be needed to circumvent it. That would be the most honest
I would say salience has been shown in the economic literature also to matter. And we've seen it with the pandemic, we've seen it with the war, we've seen it in many examples. Yeah. That until risks become salient, often they're not particularly well priced by financial markets. And this is a question when it comes to physical risk, but also potentially transition risk questions too. And salience on the part of policymakers until they witness the shock. You could argue the pandemic had the same. It had a health component and it had a policy adjustment component in terms of lockdowns, which occurred simultaneously and worsened the situation, arguably to some extent.
So another example is really very close to climate issues is the war. One could say we could have had anticipated that our energy supplies are not diversified.
But in a sense, you can be adaptive. It's not fully rational and forward-looking.
So I'm just thinking that it is important for the reader of your study to have an idea about the depth in which the microstructure is being considered, or whether it is basically a reduced form, and then it should make this point. So I have two questions here in the Q&A that relate to this. So I read them both, and then maybe some can just take them up. So the first question is it's about slide 14, I guess, about short-term models. Do you have an explanation why in the graph on the right side, GDP reacts differently to the three risks, especially heat waves and floods? So I'm not really interested in the answer itself, but how can it be that you have different types of risks that have different responses? So there should be, that's suggested, in my interpretation, there is a micro level in your model that treats heat waves differently from floods. And I relate it to the second question, which is, does your model incorporate effects through value chain disruptions? For example, if suppliers in Asia are severely affected, there could be large effect in the euro area. So again, the question is, what is the detailedness of your model with respect to interconnections, or is this reduced form, right? And basically assuming that there is some effect.
So we have a multi, just before I pass back to Stephan and Kat, I think we have a myriad of models. So Stephan presented you some, which had a reduced form flavor to them about PD, transmission, interconnections, which is largely agnostic to the channels, but I think gives us some elements of understanding the systemic amplifiers. Kata had given you some models which actually have a more detailed transmission mapped out, and she can answer some of these. I can say it quickly. When you have floods, it does lead to immediate capital stock destruction and then rebuilding, which is a very different actual transmission than when it comes to areas like heat stress, which might be more productivity shock. Or when it comes to transition risk, which is going to be one where you think about the shock potentially being in the form of production function impacts through energy prices, production function impacts through technological changes, depreciation, and the like. So the channels are mapped out. Katarzyna, I think you can speak to this, but the models have incorporated these elements.
I think, Paul, you said it all. So I wouldn't say that the model has maybe a very explicit microstructure, but we do use a semi-structural model, which is, I mean, in this case called NIGEN, in which we map those climate risks in a simply different types of events. And accordingly, those events will harm GDP, either from the capital side or more from the labor productivity side. Transmission, policy lags, risk lags would be just different. So in this sense, it does pay off to look via the lenses of the models which were built already for different purposes on the new challenge, which are climate risks. And if I might answer one more question, which we didn't read out, but I think it's an excellent question by Lotta. So the very first one in our list, and let me kind of just read the beginning. Aren't you mixing risk analysis with climate policy issues? High CO2 emitters will be hit by CO2 tax increase, but institutions hit by floods or fire are not necessarily climate villains. And yes, we do mix up risk analysis and climate policy issues. This is the most straightforward answer, but we do it consciously because we see relationship between them. So for us, climate concept relates to two types of, if you want to say, call it scenario in the work stream I was working. So it is one thing which we think of when we think of climate risks are the risk of policies, disorderly policies, the risks that the private sector will not adapt to policies, to tax increases timely enough. And the other risk, which is not always related directly, but only on a system level, is the risk of floods, droughts, etc. And absolutely, this is not that the companies which are villains are not necessarily companies which will suffer the most from climate, from physical risks. And I think it's like there is a lot to support this intermediate overlap, like a not immediate overlap in Stephan's work, especially where he looks at the distribution of both risks. We acknowledge it, but we see it as an additional signal for a policy action, bringing us to the policy aspect. So yes, we are mixing it up, but this mixing is conscious, and this mixing to a degree is necessary to derive from it any need for policy action, as Michiel was presenting. That was
one thing to add is we probably, in a sense of modeling, it's true that the micro foundations might not be as robust as we would like, but particularly given it considers very long-term scenarios with many complexities. At the same time, I think we have to avoid building a canonical Lucas critique model, which would involve everything in the economy, including climate. So I think what we usually are looking at now is a variety of models tailored to the question we need to answer. Stephan, you had one on value chains, which I think is also different.
Yeah, so I showed one exercise now where we asked a question about reducing carbon emissions by 10 or 30%. That was on slide 12, and which was more of a static exercise, and where we could kind of model the static part more in detail and these value chains more in detail. The question that was posed was disruption in value chains, and this very much speaks to the recent paper by Bachmann and co-authors on the energy policy, where this became very much of relevance. In our case, what we did is relatively smoothly, adjusting those, that there is not from kind of a complete disruption taking place. But we have also used the same kind of model and setup for these types of questions, like the energy and case, and in future we might thereby also look at to specific disruptions of specific energy forms for that. So this can be done. It is nevertheless, and I think that's a challenge for the macroeconomic or macro financial linkages, so to say, over time, is putting this level of granularity and at the sectoral level with a time dimension to it. I think that is current work on to be done.
Yeah, this is, I think, very understandable. I mean, you are not modeling all risks that may happen in the world. So we are not, in this model, you are not talking about a war or something which is completely unexpected event that takes everybody by surprise, where these supply chain things can happen. But we talk about, or you talk about, these long-term risks where we all know they are happening. Everybody can adjust. So nothing is really fixed, right? It's like in a flexible system. How flexible can your muscles and bones adjust to this posture that you are required to deliver, to present? And I think this is how explicit is this variability built in the system, right? And I think there's a lot of I would say, interpretation that's implicit in your model, which I would like to, maybe it's written, so I haven't read your study, I'm just listening. But in the presentation, that was not a big part of it. And I think for also gauging the relevance of your extreme results, this is probably for policymakers important. So let me take up one question that's also here in the Q&A, that relates to how does the financial sector respond to this potential buildup of risks, maybe on bank balance sheet. And Kylo is asking, has increased claims on insurers been factored in the losses that may be faced by the three sectors? So there's an insurance sector that may take part of the losses. I mean, the insurance sector itself may have a problem, but it may also absorb the losses because they foresaw that there is such a loss event at some point in time and had adjusted their premium accordingly. Is that part of your model building? It's not only banks, but it's also I would say the supporting factor that insurance can play here.
So work continues on modeling the insurance sector, but predominantly what Katarzyna showed you was the asset side of the balance sheet. So what they hold in terms of corporate bonds, corporate equities. But of course, the liability side, what are they actually insuring? Are these losses? I think that the broad finding that Stephan hinted to in showing this heat map earlier, only 35%, we were very shocked to see only 35% according to survey data of European hazards are insured. 2/3 are uninsured at the moment.
Yeah.
Before we get to a stage where insurers might ask themselves, are these systematic risks that I can diversify or not? And if not, maybe I'll have to raise my premiums or reduce coverage from a very low starting point, surprisingly though. So to your question, no, we haven't infused the insurance questions fully into what we're doing on the modeling side, but this is ongoing work. And it's I think, something we need to think very carefully about, not least because systemic risk can manifest itself through sovereign step-in risk.
Yeah, this was one other question that you call it sovereign
step-in risk. But the sovereign would have to actually step in
exactly.
and make public.
Yeah, so there may be so it may be rational from the point of view of households not to insure, right? Because this increases the likelihood, and you also stabilize the banking system.
Absolutely.
But perhaps before the households really reflect on not insuring, there is the issue that insurers may actually not offer anymore certain insurances. Why? Because the risks are just too kind of clustered in specific regions or of specific types. And if you would ask premium for that, these would be, I mean, destroying their kind of reputation potentially, and that they're overpriced for these types of risks. So this is indeed an area where kind of more is done, and together with the insurance supervisors, but also on this link between banks and insurance.
And over the long term, this has real consequences, right?
Absolutely.
So if there wouldn't be insurance, if I think of the Mosel area in Germany, where a lot of houses were destroyed completely unexpectedly, government came in, gave a lot of support, and now the people are building the same house at the same places as before. I mean, it's completely crazy. And so if that will all be left to the insurance market, they wouldn't build that anymore because it would be too expensive. So there are also self-inflicted risks, right, in this. So let me go to another area of questions that relates to the, let's say, the more the regulatory side. So I'm quoting here from Marcel Magnus. Yeah, you can read it now even. On macroprudential capital buffers that you mentioned as a policy consequence, and the experience that we have made during COVID-19, that they are not really used for the purpose they are meant for. So question is, do they think this is an appropriate instrument given experiences we had in prior crises?
So indeed, I mean, the question about usability or releasability and how much releasable buffers can be used by banks is definitely something we have in the back of our mind. I mean, there's extensive work now also internally to look into sort of the COVID period, think about sort of the implications of the COVID period for macroprudential policy and macroprudential buffer. So that's not necessarily focus of this group, just to be very clear. But we are very much taking this work into account. So we have also some references in the report that highlight that we might have to think about releasable buffers. We have to think about how this can be used. So it's definitely something we have in the back of our, and will be part of a consideration when we actually design if ever it will be employed. So it's definitely something we have taken into account, we will take into account going forward. But yeah, acknowledge that this is not a straightforward issue to solve.
So I think we have exhausted the questions in the chat. Just going through.
I saw one about scopes of emission. Do we take into account all scopes of emission?
Yeah, scope 1. Yeah.
The difficulty, I think, two things to quickly mention. Scopes 1, 2, and 3. So 3 is of course downstream emissions. Is mainly estimated, and we rely on external providers here. We try to in-house as much climate expertise as we can, but arguably we're still mainly economic and financial people. So we take those estimates as given. The difficulty, I think, in estimating this, particularly for financials, is financial institutions themselves have scope 3 emissions, which is who they're lending to, which is closely tied with this dual materiality question. You have also the financial sector lending into climate outcomes. So it is a complex one. It's one we're trying to tackle, at least for the first stage, is to try and measure it well, which is what the scopes of emission, whether estimated or measured, actually give us thus far.
So let me turn to the let's say the policy implications of your work. So where do you think? I mean, you outlined this a bit, but even now, take into consideration our discussion, what should policymakers learn from it? And the one set of policymakers are those that look at bank capital and banking supervision. Basically, other policymakers are those that think about setting rules or regulation that deal with the aspects of climate change. So what should they learn from it? I mean, this is the bones part of your body is the regulation that may adjust that. So, I mean, much of our discussion was about to what extent is your modeling exercise assuming rational or irrational expectations, right? And I'm a bit advocating rational expectations, but of course be made explicit. So what exactly drives rationality of the system in response to a foreseeable damage? And is there anything that from your deep thinking about such a long time about this problem, be it in your model or not, but what you would think is an advice for the policy making world that they should, how they could, let's say, maximize flexibility, adjustability of the system?
Good question, a deep question. I think, look, two things to quickly mention before I might pass over to Michael too. There are clearly market failures. Going back to first principles, why do we want policy? It's because of market failures. And two that stand out, informational ones and allocative ones. And the informational ones are being dealt with, where we have a variety of initiatives underway, but they will take time to materialize. And in the meantime, I think you just have to look at ESG scores. They're all over the place. So even if you have potentially, arguably what should be measurable risk, it's not particularly well measured in a consistent way. So we have disclosures which are meaningful, some which are less meaningful, and you have an adverse selection problem. So in this world, you can imagine these informational market failures need to be dealt with as a foundational element before you can think about any rationality to bring about efficient outcomes. The second, of course, the allocative side is the one we're talking a bit more about, where policy can make a nudge, particularly if you're in an equilibrium where salience might be important in making a risk priced or not. I just say the other thing that I think has been a benefit of our work for policymakers is it's a triage. So whereas banking sector regulators are often focused in their own backyard, insurance regulators, market regulators, our view is that you should think about transition and physical risks in a way that might be able to be unbundled and distributed across these different regulatory bodies. So Michael talked about insurance protection gaps. Obviously, that's an insurance question. which might reverberate back to what banking sector regulators have to think about.
Indeed, indeed. So the lack of insurance of collateral used by banks, for example, may have implications also for banking regulation or for banking supervision. So I think these are cross-cutting issues that I think from this holistic perspective we're taking, I think we can provide a meaningful contribution. And maybe, I guess, when it comes, I mean, we speak obviously only in the policy part, we speak mainly to regulatory policies, macroprudential policy. So one aim obviously is to sort of make people aware, also policymakers across the globe aware that climate risk is a financial risk, that there needs to be adaptations by banks' risk management, by in terms of supervisory approaches, and that it's also already helpful work in the Basel Committee. So we recently published principles for the supervision of climate risk, which sort of these type of, so with this work, we try to sort of influence also these sort of processes that lead to these global standards. We also actively involved with European regulatory policymakers, not necessarily the public policy. So this is at least speaking about, for my part, not so much the focus. It's really targeting the European discussion on the regulatory response to climate change and to what extent the regulatory framework, the supervisory framework, the disclosure frameworks need to be adapted to address market failures, informational failures, and how then possibly also need to adapt to also build resilience ultimately. So,
but this would, if I take your points together, I would say that if I have confusion about data, so if disclosure is in the current ESG system where everybody who likes it can publish his own ESG metric, and everybody uses this as if it were some objective information. So this can create a risk. This can be a risk if you don't remedy this.
You could have overshooting both sides.
Yeah.
Green assets could be overvalued or completely neglected.
Yeah, or they cannot be identified properly. And I mean the whole thing is this information revelation or information production side. I see this as a major risk factor if the world doesn't agree on how to measure where the risk could be embedded. So just to give some information about, let's say, CO2 at the corporate level, if you're not able to do this, then it will be very difficult to as a financial institution to adjust their loan conditions, their loan terms in a proper way, so that they avoid potential risks that may go along with CO2.
Maybe just because I think it was also a question in the chat, to what extent such standards already exist. So there is already work, there already exists. The green bond standard has been proposed by the Commission. There's also the sustainable finance disclosure regulation coming in starting 2023. We have basically, particularly ESG funds also being required to disclose information about ESG. So there's already some work. So it's not like I just want to highlight that there's already something in train and in place. The question is this sufficient? Do we see then? Do we see sufficient harmonization? Consistency?
Is this a risk factor?
Yeah,
that was my question.
exactly,
Or is it just a fact of life and we can't do anything? But we can do a lot about it.
I think
that's doable.
Now these things aim to address this risk. So this risk of proliferation of different standards, I think, partially.
Well, I think to end on a positive note, policy can make a difference.
Yeah.
Definitely. Yeah, in standard setting, and also that institutions such as the ECB, which we've also noted some ways in which we're tilting around corporate bond portfolio, can also act maybe as a catalyst to also see that there are some potential areas where you can actually leverage these and multiply them out in terms of systems response.
I think this is a good conclusion, right, from our discussion. So I want to thank you, everybody, of all four of you, for your input and for your willingness to discuss this. And I want to thank the audience for asking very interesting questions. We will keep these questions for us and convey them to you. And I hope I'm not saying something wrong, but everybody in the audience who wants to receive the slides will receive the slides from us. Send us a short message at SAFE, and we will send you the slides. So thank you very much to everybody, and I wish you a good day.